Fusion Building Wealth Through Your Business and Pensions webinar. We'll talk you through exactly what kind of options you have as a small or medium-sized business, how you can use your business wealth to maximize your personal wealth, and how to do that in a tax-efficient way consistently over time to focus on something outside of your business, right? That thing that will, be a backup or a future income for you later in life.
And hopefully most of these guys will have the benefit of selling their business as well. So it's a double whammy.
Exactly. So you've got me here, Joshua Shepherd. I work as a financial advisor here at Fusion. I've been here 5 years now. And I've also got Head of Fusion Financial, Neil Jacobs, with me.
Good morning.
So Fusion as a whole is a wider network of businesses. So we work for Fusion Financial. Within the group, we've got Fusion Tax, Fusion Accountancy, Fusion Recruitment, Fusion Legal, Fusion Consulting, and Fusion International. So the idea here is that you've got all of the professional services people that you could need under the same roof. Feed in information, feed in advice, and a little bit of guidance between the teams to make sure that you as the client are always in the best possible position and not missing out on anything that would otherwise not be covered if you were just an accountancy firm or if you were just a financial firm.
Well, we've already done the introductions, but we'll just do it again if more people have come on. So my name's Neil Jacobs. I'm head of the department, but also still a financial advisor. So have a number of clients I've been working with over the last 15 to 20 years. Lots of those clients are SME owners, directors, but we also deal, myself and Josh, with private individuals who are employed. Today, we wanted to really focus on those business owners. Josh, tell us a little bit about your background.
Yeah, so I started my career in financial advice offshore. I was in Barcelona giving advice to British expats who had moved out of the UK into Western Europe. I've been back in the UK for 7 years now, 5 years here at Fusion, growing a client bank of directors of small and medium-sized businesses. So the types of problem you have, I see day in, day out, and have solutions for many of those problems that we see. So, although it may feel like a unique problem that you've got, whether that's, too much cash in the business or, a struggle to bring money from your business into your personal names, these are things we do day in, day out here because of that link between the group of companies that Fusion is a part of.
And today, obviously, is solely focused really on pensions, but I'm just going to put it out there based on what Josh said. You just said about having money in your business. We're not even going there today on the other side of things. If you've got money in your business, one of the things you can do, hence the presentation today, is put money into the pension. However, I'm just going to touch upon it at this early stage. If you do have money in your business and you still want to have it readily available and you are frustrated, it's sitting there not growing, please get in contact with us. We've got plenty of examples and options that can get that money working within your business so you still have it readily accessible if you need it for growth or acquisitions.
Perfect. So, we'll kick off with the pension. And that is really the problem that many business owners face. A lot of your wealth is tied up in the business, right? You're drawing potentially a small salary and a small amount of dividends each year just to kind of make ends meet from the personal side. Whereas in the business side, in the corporate side, you're making sure that it's performing as well as possible. You're putting all of your time into that to grow the business as fast as possible. Now that creates a number of problems, not limited to the fact that you may have excess cash in the business, which isn't being used for the continuous growth of the business, but it's just sat there. It causes a problem to try and open up different accounts, always chasing that highest level of interest rate within the business accounts. That's an issue because you're not achieving your ultimate goal, which is to fund your personal life, right? That's how we want to make things work more efficiently, is to bring the money that you've built up in the business outside of the business into your personal name before you sell the business. Now, obviously, a lot of you, may be in a place where you've got long-term ambitions of selling the business, right? That may be something that you're thinking, well, I don't need to focus so much on creating these additional, investment funds or pension schemes outside of this, because when I sell that business in 10, 15, 20 years, that's going to fund my retirement. Yes, you may get to a place where it's achievable to sell the business. You may get to a place where that does fund your retirement. But whilst you can tax efficiently move funds from the business to the personal along the way, creating this almost pot of security for the future, it's an excellent thing to do, right? And I think, the tax inefficiencies that we all face now with regards to drawing money from the business as salary or as dividends is a problem, right? What else can we do? One of those things which, achieves a lot of the issues we face is to make additional pension contributions for the future. Why are pensions so powerful for business owners? Well, company contributions reduce corporation tax. It's as simple as that with regards to any pension contribution you make will reduce your pre-tax profit, which in turn will reduce your corporation tax bill. That's given. On those contributions that you make, there's no national insurance payable, right? So although the salary sacrifice limit or cap with regards to how much national insurance is avoidable comes in a couple of years' time, that's not the same as making a company pension contribution to your personal pension as a director of a small or medium-sized company, right? So that means that any money that you pay into the pension from the business doesn't have national insurance attached to it. Tax-free investment growth. So once that money's in the pension, that's locked away, and it's in this tax-efficient wrapper where any of the growth, any of the income, any of the dividends that are achieved within the pension scheme is tax-free, right? That will continue to roll up year after year until such time as you want to draw from those funds. When you get to that point where you start to draw down, from your pension scheme, you're able to take up to 25% as a tax-free lump sum in retirement. Alongside that, you can draw from the pension scheme very flexibly, whether that's, cashing it in to purchase an annuity or taking ad hoc lump sums of money from the pension scheme or setting up a regular income stream from the pension scheme. There's a lot of options that will enable you to achieve a sustainable income in retirement through the pension scheme that was set up whilst you had that business.
I'd also just add there that there's also quite a few options on how you take that tax-free cash. So you don't need to take it as a one-off lump sum. We've got clients at the moment that are utilising their tax-free cash to fund their early years of retirement. We've got other clients that actually don't require any sort of lump sum and wish to have a sustainable income for the rest of their retirement and have chosen to have an income where 75% of their income's effectively taxable and 25% tax-free. With the other income sources they have in their retirement, they wanted to really try and minimise their income tax over the long term. So there effectively are loads of options in your retirement, and a pension will give you another income, passive income, as well as if you've got properties and so on. It's set to that 25% tax-free, can be utilised in different ways.
Yeah, and just coming back to kind of, if you're thinking, I'll sell my business at some point in the future, when you sell that business, what you're left with is these kind of post-tax funds, which then may provide you with an income in retirement. Now, obviously that's post-tax funds. The pension scheme is almost pre-tax funds. So when you draw down from it, you're drawing down and you're paying the tax on it. Because you won't be employed and you won't have any other kind of regular income coming in outside of potentially the state pension, it's a good way to kind of bring money in a tax efficient way from this pension pot up to that 20% basic tax rate status. So, there's all sorts of structuring you can do to make sure that you're as tax efficient as possible in your later years, whilst being as tax efficient as possible in the earlier years while you're making those contributions.
Yeah, I mean, I'd say some clients, not everyone, but some people do question the fact that why, when I have a pension, does it get taxed in my retirement? Look, the government, they're there to tax us, and obviously we're seeing at the moment a lot more forms of taxing going on and increases. But the reality is your pension pot for 30, 40 years is giving you the opportunity to invest tax-free. And at the end, yes, they'll tax you, but you've got 30, 40 years of effectively being able to invest and not getting taxed. And while it's in that wrapper, they're not taxing you. So it's that opportunity there which we really need to try and maximize.
Yeah, and if you're paying a lower rate of tax when you start to draw down on it than the tax relief you received on the way in, then you're still going to be net better off from a tax perspective when you start to draw down. So yeah, very powerful. You know, how can a company turn profits into personal wealth? Well, you know, very simple. Instead of leaving the profits in the company and paying corporation tax, and then, you know, later taking dividends, you know, from those post-tax profits, another option alongside that, really, because obviously, you know, we're never going to turn off the income stream for you and the dividends that you need to live day to day. But with those excess profits, you can make a contribution to the pension scheme that reduces the corporation tax bill. It's invested for long-term growth. And when you come to draw down on it, we can try and structure it in a way which is tax efficient in the retirement phase.
So we wanted to look at an example. So we've got a 35-year-old business owner, and at this stage, doesn't really matter what they're earning, but what we wanted to do is look at their company. And their company is going to make a £12,000 contribution into their pension from the company to their personal pension. And we're going to assume that it's making a semi-reasonable growth rate on average of 7% over a 30-year period. Now, the goal for this client is effectively to build up a good pot for his retirement at 65. Now, when we look at that annual contribution of 12,000, we've got a total contribution of 360,000 over that 30-year period. We've got an average 7% growth and the compounding as well. So the estimated value of that pot at the age of 65 is £1,133,500. So we can see that growth has been achieved through that tax efficient saving from the business into the pension. No tax has been taken from that million odd because it's able to grow there effectively tax-free. So it's allowed the client gradually over time to build a nice nest egg away from the fact that they're probably going to sell their business and make some money on the side for that as well. I'd also say that the annual contribution, just from experience, Josh, 12,000 for semi-successful business owners, we could double that quite easily, for example, on many clients. And we've even got clients that are maximizing their contribution, which is obviously 60,000 a year. So what I would say is really look at your business, what you feel comfortable with. I thought we'd just look at a smaller example, but over 30 years, 12K a year, it builds into a big pot when you take growth into account.
Yeah, and again, when you take in the growth, you know, £360,000 in, 1.1 million come retirement date, of that £360,000, if that had been left in the business, a further 90,000 of that would have been payable to HMRC. So when you realize the kind of net effect of making the contribution added to the growth and the potential returns, you're in a really good position as a separate pot for the business.
So the company has made that contribution of 12,000. So we're saving on the corporation tax, which is effectively like 3,000 a year. Then the cost to the company, which is 9,000. So 12,000 gets invested for the owner's retirement. But they've basically saved on that corporation tax, and it's an expense to the business overall. So it's effectively reducing that corporation tax bill each year. Now, it's not so relevant to this slide, probably more on the other side. We do have a lot of clients that are in property at Fusion. You could start building up a pension pot. Build it up to a point where you decide to use that money in a SIP or a SAS to buy commercial property. you could then consider, or is this a commercial property for my own business, and then effectively help reduce. Well, it's not going to reduce your business cost because you still got to pay rent, but the rent goes to you in your pension. So you can utilize your pension to help in your own business by investing in commercial property, whether that's for your business or for personal benefit. And then obviously you've got that income coming in your retirement, which will help your sustainable retirement. We have some clients that decide at a later stage to sell it, and then those funds go back into the pension. But a pension doesn't need to just be funds. You do have other options of investing, and it is something that we've got vast experience of.
Yeah, absolutely. Using the pension as a kind of sidearm to the business is something that appeals to a lot of small and medium-sized business owners, because exactly as Neil mentions, you're paying yourself the rental payments rather than somebody else, right? So you're owning the property through the pension scheme. The company rents the property from the pension scheme, and that money goes directly into the pension scheme for you to use later in life, when you come to draw down on it and their business is no longer being worked through.
So potential retirement income on that 1,133,000. Well, first of all, we need to understand that there's a cap on your tax-free cash. So the maximum tax-free cash you'll be able to take is 268,275. Lifetime allowance has now ceased. That doesn't exist anymore. So one thing we know, which I've just said, tax-free cash, we've got that capped. But obviously, although you may not be able to go beyond that, you still got those tax breaks of putting money into the pension from your business. So there's still an argument that it's no harm going beyond the level where effectively you lose the 25% tax-free cash. Effectively, if we look at an income, there's so many ways we can do this. And for this one, just as a simple rule, we've got 34,609 per year. But in reality, we've got clients that are retiring at 60, 65, some earlier, and they want flexibility. They want to enjoy their early retirement and potentially retire for the first 10 years on 50,000 and then effectively see that reduced later on in their retirement. And the pension will allow us, through our own cash flow forecasting, to really strategize your retirement so we can have higher income at the beginning and then reduce it at a stage and have money left over for later on when obviously care and other expenses may be needed. But I think when you look at that, we've got a fair example of 34,000. There was still a big chunk of money left in that pot at the end of it when we were forecasting this out for this webinar. But the reality is, you can, as long as you know what your goals are, that 34,000 could be more at the beginning or less, depending on what your situation is. Because it could be that you're still working and taking income from your business, so you just want to take a smaller amount out and then increase it to a higher level when you finish work and any income from your business, and enjoy what you want to do in your early stages of retirement.
Yeah, there's no one size fits all when it comes to drawing down, but it's about understanding what are you going to need in retirement, how can the pension play a part in that, and what do we need to do to make that tax efficient, right? So if you had, just for a very quick example, if you had no need for the income coming from the pension because your business did really well and you're able to sell that in your lifetime and receive the returns, the pension can become a place where you draw down from it every year as sustainable income. But if you don't need that money, you're able to draw down from it and potentially gift it away out of kind of your natural income, because of these pots. So there's other ways of making the pension work from an inheritance tax point of view, even though from next year, pensions fall as part of the estate for inheritance tax purposes.
But for example, on that, we had a client, I think, who was back in January where they didn't require the tax-free cash and they wanted to try and get out of their estate within the quickest period. So we found an investment that they were able to invest their tax-free cash from their pension. So they took that, they gave it to us to invest in them, and they're effectively now a year and a half away from having that outside their estate using business property relief friendly investments.
So what's a common strategy for people, who are directors of these small and medium-sized companies? They want to take a tax-efficient salary and dividends, right? That's a given, right? They want to be able to make employer pension contributions to consistently move funds from the company into the pension scheme in a tax-efficient way. This allows them to invest consistently each year. And through that investment, they want to review that strategy as to what are we looking to achieve with that original investment. If we're making £12,000 contributions each year and we're 35, we want to make sure that that's invested for long-term growth. Now, if you're thinking, well, I'm not 35 anymore, I'm starting this at a much later point, that's okay as well. We don't have to invest for the long-term growth. We can focus on a sustainable, level of return in line with a reduced risk profile, which is just simply designed to sustain the money that you're putting away from the business into the pension scheme.
Josh, if people are watching this right now and they're thinking, okay, so what's the benefit of me sitting down with you, Josh? What will I get from you to help me get a clear idea?
Well, there's a number of things, but we can plan over a number of years exactly what your cash flow position is going to look like. So from a cash flow point of view, we'll take into account all of your incomes, all of your expenditures, all of your short-term, medium and longer-term financial objectives, and build out exactly what that looks like today in your current setup and in an advanced setup that we maybe look to design together. So if you're not making any pension contributions now, we can model that out to say, look, this is where you're going to be in 15 years' time when you hit 60 and you want to retire. If for the next 15 years we now add this layer of pension contributions from the company to the pension scheme, this is now what you're going to look like. And then we can compare the two. We can see whether that's affordable from a business point of view, whether that's realistic from an investment point of view, and show you the bigger picture as to how that helps you long-term in retirement.
It's certainly empowering. I've seen it from experience, a bit longer in the tooth than Josh. So I've got a few more clients coming to their retirement stage now. And obviously they've always visualized it while working with me over the last 15 years. But now we're coming to the end and we're really tailoring that retirement need. It's that if they've already achieved what they wanted, they know what they're going to do in their retirement. It's taken away a lot of anxiety that we do see people have when they're coming to retire, because they're confident in their strategy for their retirement. They know what they've already achieved, and now it's just playing it out and enjoying it. So effectively, the really important thing for you guys to do is sit down with your accountant, review your business and the profits, identify effectively what sort of contributions you can make. You need to do that on a yearly basis. It's about being consistent. You want to make, where you can, annual contributions. We have some clients that are in a position where they can make a monthly contribution, and then at the end of the financial year or the business financial year, just before the accountant's done all their accounts, they can make an ad hoc payment because it's been a good year. And if it's been an average year, obviously they'll make a reduced final payment for that year. But it's about just every year being on top of what your business can contribute for your own benefit. And obviously, if you've got other directors or family members in the business as a director, you can also bear in mind that they can also benefit from those contributions. But that will all play a massive part in creating that long-term retirement strategy and benefiting from that compounded growth by consistently making payments whether that's an annual payment or a monthly plus an annual ad hoc payment. And then that's where we can build that out for you. And things change. We have good years, we have bad, and we can build that into the plan and obviously do some stress testing for you. Annual reviews are a big part of it. So you really get a clear, concise understanding of where you're heading towards, and if your aspirations change, is it realistic? Do we need to change anything for that? Another part of it is the investments. Are the investments in line with what you want to achieve? Do we need to take this level of risk? Do we need to take more risk? What sort of investments have we got in place? Really feeling like you're in control, or at least your advisor's in control, and you're confident with them in making sure that you're going to achieve what you want to for your retirement.
Yeah, and kind of, if you're sat there thinking, I'm not doing any of this, then, let's have a chat to see what that first step would be, right? And if you sat there thinking, well, I've got a pension scheme, but I'm not sure on how much I'm paying into it each month, each year, and I'm not sure where it's invested, then let's review that. Let's understand where it's invested and whether that's right for you. Alternatively, if you've got a small, simple nest pension scheme set up, which I know a lot of the smaller companies do when they start trading, that gets set up through the accountants, and then the monthly contribution that you're making to the pension is coming out of your personal, your personal wealth rather than through the company. If you're in that position, then let's have a chat and see whether it's right to keep that going, or whether it's right to redirect those contributions that you're already making from the company rather than from the personal, which will do two things. It will increase the amount that you've got disposable in your personal name, and it will make it more tax efficient if you're a basic rate taxpayer to make it through the company.
I can tell you from experience, and I'm sure you've got, where we've taken on a client that's basically started on zero. We've invested in them on the basis that we felt that, okay, they've got a good business, we can work with these guys, they like to work with us. It's worth taking a chance in the business view and seeing where this goes. They'll get our financial advice. And 7 years later, I've got these clients that started on zero, and eventually, because their business has been growing and they've been able to make those consistent payments into their pension, they've become good clients for us. Good clients and also friends, because we've obviously worked with them over a period of time. They've benefited from our advice and they've seen their pensions grow. And to be honest, it's just having someone they can sit down with, give them that push, and before you know it, those annual contributions from the business, if you're fortunate enough to make some sizable ones, quite quickly turn into decent six figures, and then you've got the compounded growth.
Yeah, it's incredible how quickly things begin to snowball into, a good, sustainable potential income for your retirement.
I think we'll just finish off by effectively saying, look, we know that pensions, it's a marathon. So whether you're starting it later on, we know it's a long-term investment. Please have a read there in terms of, we've got to say it for any sort of presentation. Effectively, investments carry risk. And we're here to help you guys. And we'll also, there's no obligation. So if you feel that you would like to have a brief conversation, just send us an email, give us a call, respond to the link where you got the webinar, and our team will put you in contact with us. We're here to assist you, give you advice, and potentially work with you in the long term.
Absolutely. And if anyone's got any questions now, feel free to fire away on the chat. And if not, we'll just leave it a minute or two and we can enjoy our morning.
Thank you for your time today. Well, I see here Steve's basically asked what I'm 5 years away from my retirement, and I don't actually know what options I have available. Okay, Steve, there's vast amount of options available. You start with the obvious. You've got annuities where you give your money to an insurance company. They look at your age, your health, and you've got a fixed income for life. So they have improved the rates in recent years and what you can get, but effectively you're giving your whole pension pot away for guaranteed income. Now, a lot of our business clients, they don't actually, that doesn't really turn them on, to be honest, and they prefer the freedom of being in control of their pension pot, having the money invested and using something like a drawdown facility. And drawdown offers many different options, which we touched upon earlier. So we spoke about tax-free cash. We spoke about the taxable income. So we know that tax-free cash can effectively be taken as a lump sum to pay off any outstanding debts. It could be taken as a lump sum to help reduce your inheritance tax bill, or we can use it to help mitigate some of the tax in your income by taking your income where 75% is taxable, 25% is tax-free.
Yeah. Great. And Alan's got a question. I think he wants to speak. So Alan, if I'm going to accept, and I think you'll be able to speak now.
Hi, good morning. Good morning. I don't know if we've met before, but I'm familiar with Mitch and Jack, who did my IHT. And my question to you is, I have inherited a small business of inheritance through flats, and I'm at the age of 70, not 35. Now, I have turned it into a limited company, which you built a module for me. And if I was to put into a pension what I am earning from what is coming into the company, I would have to take it at 75. Am I correct in that?
No, so that's not quite correct, Alan. There's no requirement to take your pension before you hit 75, right?
Right.
There is something that happens at 75, which used to be called a crystallization event. They've changed a lot of the rules, so it's not necessarily called that anymore. But
we still have to fill in a few falls.
There's still a few falls. But at 75, all that happens is it no longer becomes in your best interest to keep contributing, right? You don't have to take the money. You can leave what's in there.
Would I have any tax? Really, I need to have a short conversation with you. But what I'm saying is, would I benefit in tax in that 5 years if I supply the pension from the limited company, as say the money comes in and take out a pension? In 5 years' time, when you draw down, yes, you can take 25%. I've got a couple of pensions now. But if I've got a state pension, I will still be back to paying the 40%. It's just prolonging, is it not, at my age, of paying the tax?
Yes, I don't think it's necessarily about your age, Alan, but it is about your individual circumstances, right? So if you've got other incomes which are pushing you, we can take this to a separate call. But in terms of, if you are already a higher rate taxpayer, or by taking a pension income, it's going to push you into a higher rate taxpayer, then we need to understand whether the contributions you can make now are going to be tax efficient for you in the long run. I think for this, let's keep it as simple as possible, without kind of spreading all your information out.
No, I will be in contact with Jack. He knows that, but I wanted to listen to what you had to say today. And I was just getting the impression that it works more if you're younger than now I've reached the age of 70.
Look, if you're 70, you could probably still potentially put 300k into a pension before the age of 75. And if you're not, and if you're still working, even more. And then at the stage when you want to take income, there are options available to you but obviously it will be looking at the individual and what other income sources they have, and looking at what's sustainable for them.
Purely from a company point of view, right? If you were paying your profits from the company into the pension scheme, right, you would take your corporation tax bill down to close to zero by making those contributions.
I understand
that is how it would be. From a long-term income point of view, we need to talk about that kind of separately.
Thank you. Have a good day. Bye-bye.
Bye, Alan.
And just one final question from Carol, who said she's got 3 different pensions, but she's no longer contributing to them. What are her options? Well, let's have a look at the 3 pensions that you've got, Carol. Right, we can understand where they're invested, what the charges are, whether they've got the functionality to make contributions from the company to one of those schemes, and potentially look at the consolidation options that are available to you. But like with Alan, let's if you've got specific examples or questions you want to ask, then get in touch with the team, and Neil and me will be happy to speak to you and hopefully add some value.
Brilliant. Thank you for your time today.
Cheers.